Assalamualaikum and a very good day to all viewers out there. Welcome back to my channel. I'm going to proceed with the discussion on fair value adjustment of the assets and liabilities in subsidiary, where you have the issue of some recognition of unrecognized assets of the subsidiary. So this is the second video of the consolidation issue listed here regarding fair value adjustment and recognition of unrecognized asset of subsidiary. We were using the example Hammock and Shanty, and I've done part A and B of the example. Now I'm moving on to part C, where part C is regarding this internally generated list of Shanty that was not recognized earlier because it does not meet the recognition criteria for intangible assets. However, as this is acquired in a business combination, therefore the internally generated asset is considered as separable and identifiable, and as a parent company, Hammock will have to recognize this asset in its consolidated financial statement at the fair value. So how do we go about doing that? It's quite easy. The asset has an indefinite useful life. If it has a definite useful life, you will have to provide amortization adjustment as well. For your information, so you are interested to watch my first video on this same consolidation issue, which is on part A and part B, which I mentioned, please check the description. I have put the link on that video, and you can start watching that particular video before you proceed doing this video with me. So stop and go back to that video in case you have not watch the video. So what I'm going to do now is to do part part C. So to recognize that this is an internally generated customer list. So when you recall, internally generated customer list shouldn't be recorded. However, this is through business combination where you are doing the consolidation. So I'm going to show you the impact of that in fair value of net asset, because this will give rise to the so-called asset revaluation reserve relating to customer list, which is an intangible asset now. So if you see here for this one, what you would do is you are going to debit intangible asset of the subsidiary, which relates to the customer list. How much? Okay, for your information, earlier the carrying amount is nil because it was not recognized. And now the fair value is determined to be 5,000. So because of that, there was a surplus, and that surplus arising on revaluation is 1,500 as well. And I was telling you that this is a pre-acquisition surplus. Why pre-acquisition surplus? It arises on revaluation date. And what you will credit is, you're going to credit the asset revaluation reserve relating to customer list. With how much? With the same amount, 5,000. So you will credit and debit with the correct amount. So when you do this recording, it will have impact to your fair value of net asset, because that happened on the date of acquisition. And that asset revaluation reserve will not be recognized. What will be recognized is the intangible asset. The asset revaluation reserve, since it is a pre-acquisition surplus, we need to go and eliminate them in the when you prepare the group financial statement. So let's look at what is the impact of that in the calculation of goodwill. We are going to also look at the impact of our first two adjustments, which is on surplus on revaluation of machinery, which is the one here, machinery. I put a different color and I will enlarge the size. Yeah, put it red. And for building, I put a different color. I will put it blue, and I will enlarge the size so that you know which one is related to which. So we are talking about that now. But it seems that when you enlarge the size, it also disturbs the other settings. So I just reduce the size and I just change the color. Okay. So what you have first is to calculate the goodwill, but before that we are going to focus on fair value of net asset. For your information, when you talk about fair value of net asset, is the net asset available on the date of acquisition. The net asset that is available will be the one of the subsidiaries only. Yeah, of the subsidiaries here, this will be eliminated because it was being acquired. So this one is share capital, which is part of the net asset, share capital plus reserve, right? The next one would be your retained profit, which is the pre-acquisition profit that we have already calculated, not calculated, given to us. The one here in this diagram, which I have already highlighted much earlier, this one. So you're going to take this 22 and 14, we will include in the calculation of net asset. Okay. The next one is regarding the revaluation reserve that has arisen due to the revaluation of the asset in the subsidiary. So there were three revaluation reserve that you have already noticed, where the first one was building, the one related to building, there was a surplus. This is a surplus. We are talking about asset revaluation reserve here. We are talking about revaluation surplus. Okay. So the revaluation surplus for building, this is from here, the one that we have calculated earlier, that's 60,000 for building. And for machinery is from here, machinery, the one calculated here, the blue one. So for machinery, oh, I have put a different color. So sorry, it's 25,000. It's green, this one, the surplus here. So put it here. And now you have the new item, which is your customer list. And your customer list, I also put a little journal entry here, which is the one that I have shown just now in the working part next to the question, right? So you will see it here. So you have to recognize the unrecognized customer list, and intangible asset here is the customer list, right? Intangible asset. It can also be brand, trademark, patent, or anything that is not yet recognized and now you need to fair value them. Okay, so that was to put into the fair value of net asset, or I put here FVNA. So step one now is we are done with the revaluation. So I put CYC because A was on machine, B was on building. So this is C, where C is on the customer list. Customer list with a different color. Right, different color. Okay, that was the one that you have. So I have put the workings also there. So now is to calculate to do the next step, which is to proceed with the preparation. First thing first, do the calculation of goodwill. So I'm doing for calculation of goodwill for ordinary shares. So I'll take the consideration transferred that is directly from your given in the question. It was given here. If you do not know where to get it, let me show you. It is here. 194 for ordinary shares, 20 for debenture, and 70,000 for the preference shares. We'll have to include that in the calculation of goodwill. So therefore 194. The next step, step 1, right? Step 1. Step 2 we have done. And when you do step 2, you get the total. The total is 226, the fair value of net asset. The non-controlling interest here is measured based on the proportion of net asset. So the step 3 is to calculate the non-controlling interest. You take 226 times 20%. 20% is the NCI percentage for your ordinary shares. Right, on NCI for ordinary shares. So you take that percentage, you get the figure here to be 45,200. You total up this is what you call A, and this is what you call B. If you watch my video on Goodwill, and now you'll get the first Goodwill, which is the Goodwill for calculation of the Goodwill on consolidation for the acquisition of equity share. The next thing that you need to do is to calculate the goodwill for the acquisition of preference shares. So the consideration transferred, as I mentioned, was given in the question, 70. And that will have to be added with the non-controlling interest. So here there are none, since we acquire 100% of the preference shares. So we do not have non-controlling interest. So if you have, you need to take the percentage of the given percentage perhaps, and you can do the calculation easily. Next, then you will total up and you will compare with the carrying value of the preference shares in the subsidiary. The carrying value of the preference shares is the one as per the soft P, which is this one, 60,000 there, the one in the purple box there. Next, you get your consideration transferred plus non-controlling interest greater than the carrying value. That will give you goodwill on acquisition of preference shares. So now the total goodwill become 13 plus 10, 23,200. You will proceed again for the calculation of goodwill for debenture. Rarely that you will have goodwill on debenture because debenture is a liability. However, we still make calculation because the consideration transfer is 20,000. That will be compared with the carrying value of 5% debenture that was being acquired. The carrying value was 50. Again, show you, because in my other videos later, I won't be focusing on calculation of goodwill. I will just focus on other intercompany transactions. So 50,000. So that 50,000, what you acquired, if you see here, is 20,000 from this 50,000. This 20,000 is what you acquired. So 20 divided by 50 is what gives you 40% here. Therefore, that 40% will be multiplied with the 50,000 carrying value, that gives you 20, and therefore it gives you no goodwill. At the end, the total goodwill or the net goodwill, total goodwill on consolidation, the net goodwill is 23,200. There are no impairment of goodwill in this question because that is not our focus. Our focus here is to deal with the fair value adjustment. Okay, now we prepare the schedule to arrive at group reserve and the non-controlling interest as at reporting date. How do you prepare the schedule? Okay, when you want to prepare the schedule, you need to look at how many reserve do you have at the end of the year. So if you check here, you have retained profit and general reserve, right? So there will be column for retained profit and column for general reserve for both subsidiary and the holding company. And then you also need to include the column for the non-controlling interest at the end of the year. Remember, the shareholding in the subsidiary is not just by you, the parent, but also by the non-controlling interest. It does not matter where you put the non-controlling interest. You can put it here or you can put it the last. So I put at the last column. So I start off with my first item column here. The second column is my retained profit. Please make sure you make the column very organized. And then retained profit means the retained profit here, Shanty. Shanty is the subsidiary. Sorry, this is regarding the company. Wait, let me check. I think I put the wrong name. Yeah, Shanty and Hammock. Okay, Hammock and Shanty. It's not hairband. I'm not sure where it comes from, but let me just make some calculation. Hammock, and here should also be Hammock. We just change it. Okay, done. Right, so you can see this clearly, I think. Okay, we will make it wider for you. Enlarge the size. Right. So now the first thing that you need to do is to put the non-controlling interest amount that you have at the beginning or on the date of acquisition. This is directly from the calculation of Goodwill. So I just put a different color. So there are so many colors here. I take this color, 45,200, and that 45,200 comes from here. This calculation. Okay, I hope you won't confuse with other colors, so I just choose this 45,200. In case you have non-controlling interest for preference shares, list it here as well. Next is to do things for Shanty, right? Okay, for the retained profit, what you will do is, now you're going to go and list down all the balance of reserve that you have. List down the balance of the reserve that you have as at the reporting date. So put all the balance that you have. You don't have to do the color like this. I just would put without color. So 60,000 is the retained profit of Shanty. 90,000 is the retained profit of Hammock. So that one is directly from the statement of financial position given here. So if you see here, this is where I take the figure from: retained profit of the parent, retained profit of the subsidiary, general reserve of the parent, general reserve of the subsidiary. You just take that first. So we have done that. Okay, I have put 5 columns here, 1, 2, 3, and then this last 2 column is for, the last column is for a non-controlling interest. The last 2 is for general reserve of holding and general reserve of the subsidiary. The first 2 columns next to the item is the one for retained profit. Next, let's do the adjustment for the subsidiary first. For subsidiary, what you need to do next is to adjust the profit at the end of the year and take out the pre-acquisition credit balance, 22,000. If you have a pre-acquisition debit balance or pre-acquisition loss, that should be added, and that will give you the post-acquisition balance. However, this has not been adjusted, and where you would see that when we were doing fair value adjustment, there are adjustments that we have done that affect the retained profit. And this one is your consolidation adjustment that you have done earlier. You have done that much earlier. If you see here, this is regarding depreciation adjustment, where 24,000 consolidation adjustment 6. Another one is the adjustment on depreciation as well, because that affects SOPL, right? Which is 2,000 consolidation adjustment number 3. That's why we put numbers so that easy for us to cross refer. So I'm going to put the numbering here as well, so that easy for you to refer. This one is consolidation adjustment number 3, and this is consolidation adjustment number CJE. I put CJE 6. So this is just some kind of notes to let us understand better. It is notes to the account, so I just put here remarks for this column, but this is not part of the answer. Okay, the remarks column will let you have a better idea where do you take them from. So what you have is directly from the working, yeah, 24,000, because you say debit retain profit. Debit mean to reduce. Much earlier, go and check the adjustment. The second one is to debit the retained profit as well, but that one is relating to the adjustment for depreciation that was under provided for building. And now you have the post acquisition or the adjusted post acquisition balance. Adjusted post acquisition balance, and that adjusted post acquisition balance is 12,000. This is the one that you will segregate between the group or the parent and the one of the subsidiary. So what you will segregate, if you can see here, you are going to take 12,000 times 80%. 80% is the percentage held by the parent in the ordinary shares. So that will give you 9,006. The remaining will be included in the non-controlling interest column, where that one will be 20%. 20% from 12,000. Just a simple calculation. Done with the retained profit. Now we are doing for general reserve. General reserve, there are no adjustments so far. So you just take out the pre-acquisition balance in the general reserve. You have the post-acquisition balance, the unadjusted post-acquisition balance, right? 10,000. You will have to go and show the share of the group based on this 80% ratio. So that gives you 8. The share of the parent and the share of the non-controlling interest is 2,000 if you take 20% of it. So now you have the total for your group retained profit, group general reserve, and group and the non-controlling interest. And that figure will now be shown in the consolidated statement of financial position. So our next task is to prepare the consolidated statement of financial position. I'm starting off with equity today. So for equity section, I'm starting this to highlight to you that the ordinary and preference shares that you will show here will just be the one of parent company. The one of the subsidiary has been eliminated. So when I talk about elimination, if you can still recall, there were journal entry that I have already shown you in my other videos that you need to eliminate on the date of acquisition. All those things which were the fair value of net asset on the date of acquisition. So that has been eliminated here. So that's why it is not there. As you acquired the subsidiary, you also acquired reserve and other net asset as well, right? Okay, so these are the things that you should have done, but I skip this because this is not required. But if you do it, you can just make your understanding better. I only suggest you to do the consolidation adjustment for the items that were under the consolidation issue or the consolidation issue like fair value adjustment. So I suggest you to do adjustment for the 7 CJE that I have shown earlier. Next is to show you the non-controlling interest. The non-controlling interest is going to be taken from here. So let's put a different color. For the non-controlling interest, we use purple. So the one here, yeah, is from the schedule that we prepare. The next item is the group reserve. So the group reserve that you have would be, first is the consolidated or the group retained profit, right? You can put here there the group retained profit as well, and that is going to be, I put red just to make sure you can see it from far. So the 99,600. The next one would be your group or consolidated general reserve. Consolidated general reserve. This is the one. I put some color there, green, right? Done. Now we go to the non-current liability. For the non-current liabilities, you are going to add or combine them. Combine the one of the holding with the one of the subsidiary. The one of the holding from the SOFP was 60. The one of the subsidiary that should be added here is the one that was not acquired by the parent. So remember, you acquire 40%, 60% was unacquired, so that will be added. So 30 plus 60, that will give you 90. So you combine H plus S. Same goes for the current liability. There are no adjustment yet so far. So you just combine 41 of holding plus 63 of the subsidiary, and you have your first total. The next one, we go to the asset section. The goodwill on consolidation was unimpaired. Maybe the impairment test was not conducted. We just take the total goodwill that we have calculated. That is being capitalized here. The next one is the item relating to the asset. So for building, what you need to do is first you add or combine the holding of and the subsidiaries asset at cost. So this one is building at cost. I put here building at cost because this is available at cost. If you have the carrying value will be put as it is. But here you have the cost as well as accumulated depreciation. The one of the holding is 280. The one of the subsidiary was 110. What you need to do here is you need to go and adjust for consolidation journal entry number 4 and consolidation journal entry number 5. Consolidation journal entry number 4 is regarding accumulated depreciation that you have eliminated. Consolidation journal entry regarding this that you have eliminated. Okay, that one that you have eliminated much earlier. Next is surplus, is for the consolidation journal entry that you have done for your building. Consolidation journal entry number 5. You can check this later. Yeah, here is the consolidation journal that I have included, right? So that is what you need to adjust wherever it affects the building or the C/P as per our working. Next, so after you have done that, the surplus is added because we debit, the accumulated depreciation because we credit the building account. So here you will have the cost combined to be 310. Now we go to the accumulated depreciation that will be remain here. The one that will remain here is 110 because you eliminate the accumulated depreciation that happened on the date of acquisition, or the one before the date of acquisition was being eliminated, and the under provision of depreciation of the subsidiary is being added because you debit retained profit, right? And you credit accumulated depreciation. When you credit, you provide more depreciation, so you credit your accumulated depreciation. So you will give you 110, and the carrying value now is 200,000. You will repeat the same for your machinery. Yeah, the same thing, only that the journal entry is different. Where the consolidation journal for machinery was consolidation journal entry 1, 2, 3, right? So consolidation journal entry 1 and consolidation journal entry 2 is what you have here. 15,000 here is when you eliminate the accumulated depreciation. Surplus is when you recognize the pre-acquisition surplus. So that goes to 225,200. Less accumulated depreciation. The elimination here is the elimination of the accumulated depreciation. And the under provision is to provide additional depreciation because it has been provided based on carrying amount of the subsidiary. Now you go and provide group depreciation, you adjust them. So you have 56,200. Here 169 is related to the total here. The next item is the current asset here and the intangible asset as well. Tangible asset that you have recognized during the business combination, which is the one give rise to parent and subsidiary relationship now, is the customer lease of 5,000. There were no amortization since it has indefinite useful life, so 5,000. Current asset, you just add up, no adjustment so far. So 289. With that, you have the total 289. You just combine. You can see where do we get the item. I put the remarks here. You can check that. Okay, I'm giving you a full view of it. Okay, that was the full view. And at the end, that's it. I hope you have got a very good understanding of fair value adjustment of asset in the subsidiary and how to recognize the unrecognized asset of the subsidiary during consolidation. With that, I thank you for watching. I will see you when I will see you. Keep practicing. Sometimes talent does not help, but it's our effort that will help us to go further. That I thank you. I'll see you when I will see you. Assalamualaikum warahmatullahi.